Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, January 2nd, and then see how things look for Wednesday, January 3rd. And this is the first actual video prepared in 2024. So again, I want to say Happy New Year to everybody, and I hope you had a nice holiday season, and now we get set to move forward from here. We didn't have a positive start to the year. Seasonally, we were looking fairly positive. We're still in this period that we call the Santa Claus rally. We have one more day left, and however that ends will determine if the Santa Claus rally is positive or negative. We are starting to see some weakness. We're still continuing to be overbought, so we're getting a lot of mixed signals right now. We want to respect the fact that the market is pulling back, but at the same time, we're still maintaining a positive stance. However, if that starts to show some more follow-through weakness, we have to heed that and acknowledge it for what it is. We have one major indicator that I think is major that has switched over negative, and that's the parabolic SAR. I'll show you that chart later. To me, that's a significant move, but we also saw that a few weeks ago. It turned positive for a couple of days. Then we saw a nice up move and it switched over negative a couple of weeks ago. Then we saw a nice up move and then it switched back over positive. So there's nothing concrete about any of this, but we are seeing a lot of things continue to line up, suggesting that some kind of a pullback, if not an actual decline, might be in order. But at the same time, we have positive seasonality that's working for us. All right, let's go back and talk about what happened. Right at the open, the futures had been positive over the holiday weekend. I kind of keep an eye on them all the time. And then as we got closer to the open and as Europe started to see some weakness, we saw that drift over into the S&P 500 futures. So we ended up having a gap lower open with prices dropping below S1 right off the bat at 47.52. We found support when we dropped just a little bit below S2 at 47.34. Then we tried to bounce up once. It was kind of like a little hiccup. We got up a little bit, but then we fell right back down. This failed. And then later on, we were able to rise back up to S1. As the day went on, prices fell from S1 back down below S2. We found support at right around that 47.50 level. That's not an exact number. That's more of a range. And then we did see some buying going into the close, which took prices back above S2. We were down 0.57%, and we were down more than that. But to see some buying coming in, at least near the close, that helped to keep things a little bit more positive, even on a down day. We were back to above average with volume, which is not a surprise. The holidays are over. Folks are coming back. They're back at work now. They're going to be starting to buy and sell. We are still positive with our technicals. We are seeing some signs of weakness. We're seeing an exhausted market with some of our overbought conditions. And so seeing things retreat would not really be a surprise as long as we maintain that long-term to even intermediate-term positive stance. Right now, that's still hanging in there, but we want to watch this day by day to see how things unfold. Because of this idea that we're going from a rising interest rate, higher inflationary environment down to where inflation is more under control and the possibility of interest rates actually going down. Of course, we're keeping an eye on all the different geopolitical events. There's things happening in the Red Sea again that could escalate what's happening in Israel. So we just know that sometimes those things can happen. They can have an impact on the markets, specifically the dollar or oil or gold, and then that can bleed through into stocks. Some comments that we can make. We have one day left of the Santa Claus rally period, and we're wondering, is that going to end up being positive? That covers the last 5 trading days of 2023 and the first 2 trading days of 2024. Wednesday will be the second trading day. And then we're also wondering about this January effect. That tends to favor the small caps and even the mid caps. Well, it didn't really help them in Tuesday's session, but there's really no definition to that for the January effect, at least that I could find or that I've seen over the years. It just kind of runs until it doesn't run anymore. The mega caps did underperform the broad market, which could be taken as positive, and that we're seeing the broad market hold up a little bit better. You could take it as more negative because the mega caps, when they're under pressure, that drives the indexes down. And some of the weak areas in 2023 saw some initial buying on the first day of 2024. Growth continues to underperform value. And to me, this is kind of a big thing. We're seeing growth just kind of fall off a cliff. And I'll have lots of charts to show you that. The parabolic SAR has turned negative, as I mentioned, and that's kind of a big deal. Doesn't mean it has to stay that way, but for right now, we just want to be aware of that. On a short-term basis, our list is pretty short now. We still have our short-term ADX. It's rolling over and dropping below the moving average, suggesting a weakening trend. Our 20-period exponential moving average and still a couple of the charts on our stochastic study that we look at continue to be extreme positive. And we already have an oversold or extreme negative indicator, our Stoch RSI. Intermediate term, the list is still kind of long, so we're still in a more of an overbought condition, but the list is getting shorter. Our ADX is still giving us an extreme reading. It's starting to drop below its moving average as well. The 50-period moving average study, the rate of change going back 50 periods, both the PMO oscillator and the studies that we look at, the Chaikin money flow, as well as the bullish percent index for the S&P and the NASDAQ 100, and then our longer-term new high, new low study based on the S&P 500. And then we have our 150 and 200 period moving averages that are still extreme positive. And we're also wondering, is the scenario continuing to shift? We're going to get some major economic reports in Wednesday's session. We're also going to get the employment situation on Friday, and that hopefully will be more telling about this scenario that we've been working with. The idea that the Fed may be done raising rates, that they're possibly going to cut rates. The market is starting to price in the idea that they could cut rates as soon as March. The dollar was up and interest rates were also up. The 10-year yield ended up closing at 3.95%, still under that 4% level. And the 10 to the 2 and the 10 to the 3 month, those yield curves are still inverted and they're going back down again. So they're becoming even more inverted. When they were starting to come back up, that's when interest rates were going up. Now that we're shifting over a little bit, we're seeing that inversion even get more pronounced. Sentiment is still extreme positive. We were unchanged from the last reading at 76. We're above that 75 level. We're still at 76, showing that folks are a little too optimistic. Maybe they're starting to take things for granted now. The market doesn't like that. And when it starts to get to an extreme positive reading, we look at using this as a contrarian indicator. Our trend is still positive because the green line's on top, but it's weakening now. We're dropping below the moving average. Our bias is negative because we've had 2 down days in a row, and I've switched our momentum back over to mixed. If we have another down day, that'll probably switch over to negative, or if we have an up day, it could go back to positive. But we're seeing a little bit of cloudiness where things were more extreme positive. The economic reports that came out, not anything really major. We did get the S&P Global Manufacturing PMI, the final reading. This is a little bit concerning. This is manufacturing. We're going to get the non-manufacturing later. It's under 50, so that's showing some contraction. The reading came in at 47.9. Last time it was at 49.4, so a little bit of weakness there. Construction spending was up, but not as much as they had expected. It was up 0.4%. They expected it to be up 0.6%. Last time it was up 1.2%. And here are some charts. This is the manufacturing where it's dropping off, but it's still coming down below this 50 level. And again, this could be good. The market right now would probably take this as positive because it's not showing anything really inflationary. But if this continues to fall, eventually this would turn over into bad news if we see more economic weakness. Construction spending did come down, but it has been going up overall year over year. Here's private construction spending where we're going up with residential spending, but we're starting to come down with non-residential construction spending. And here's the month over month where it was still positive, but it did decline from the previous month. Here's the intraday chart where we gapped lower, and because we had some pretty muted sessions last week during the holiday season, the fact that we really gapped down kind of made it look more pronounced than it really was, but we did come down below S1 right off the bat. We came down to S2. We tried to bounce up off of that once. That didn't happen. Then we finally were able to bounce back up to S1 before declining back down below S2. We set the low near the close, but then we ended up seeing some buying going into the close to really improve things. The intraday chart, we really spiked around here as we had some things really going back and forth. The futures had been positive when they started to trade again, and then they started to drift off negative as things were developing in Europe. Then we saw a real gyration here. We ended up opening lower. They did come up a little bit, showed a bit of an improvement. Then we saw the weakness and then some strength going into the close, and they're pretty much unchanged now in the initial overnight session. This is more of a concern too. The blue line is growth, the red line is value. Value was up on the day where growth ended up being down. And when we look at the growth to value ratio intraday for the S&P, we just really hammered down right off the bat. And that is quite negative. We want growth to do well to give more support for the indexes to go up. If we're turning more negative, we would see this ratio going down, which is what we're seeing right now. Now, it could repair itself from here, but right now it's not really giving us an awful lot of confidence. When we look at the end of day chart, growth was down 1.6%, where for value, it was up with the large caps. We were also down with the mid caps and down with the small caps. And here's the other ratio end of day that we look at. We have been declining as the S&P has been going up. This is a warning sign that I've been trying to make aware for quite some time. Now it's really starting to show some more weakness. If we don't see this turn up pretty soon, this could have a real negative impact on the overall indexes. And we're also seeing some weakness now when we look at discretionary versus staples. We're starting to go more into an uptrend with discretionary when we look at the equal weight. We're seeing some improvement with the staples, but when we look at the ratio down on the bottom, it's still positive, but it has been coming down now for the past few sessions. Keeping an eye on our trend, this is the intermediate term ADX, which measures the condition of our trend. We're dropping below the moving average. It's still well above 40, but this could be showing some signs of weakness. Even though the green line is on top, it is declining. We would still default to positive there. Intermediate term, we're dropping a little bit faster with the ADX below the moving average. The green line has dropped below 40. The red line starting to come up, but again, we would still default to positive. Volume did pick up, even though over a period of time, it's going to take a few days for this to measure back up, but it is showing some improvement. Keeping an eye on sentiment, we're still not seeing an awful lot of fear when measured by the Ulcer Index. The VIX did turn up a little bit on the line chart as well as the bar chart because we saw prices under pressure. The VIX of the VIX also turned up just a little bit. We came above the moving averages with the bar chart. We're coming up and closing right at the lower end of the moving averages on the line chart. And we're keeping an eye on this as well. This is the correlation between the VIX and the S&P. We didn't get above this dashed area. That may not matter. A lot of times when this really spikes up above the dashed line and then comes down, that's when it gives a signal. But it came up close to this area and is now starting to go down. That is when the market typically is getting kind of nervous. Typically, this will mean that we'll see some kind of a decline after that. We'll have to see how this keeps going forward from here. The equity put call ratio was pretty much flat when we compare it to Friday's session, but we're going back up now with our 5 period. Before the holiday, we were saying, well, maybe this is pre-holiday hedging. This is just some concern, and if something geopolitical happens. Well, if that was the case, they probably would have taken those hedges off in Tuesday's session. Since we had the down day, they've decided to keep those hedges on, and that's keeping our 5 period going up, which this is more short to intermediate term negative now. And we saw a bit of a tick up here with this other fear gauge that we look at, and we're seeing some deterioration here with the risk on to risk off ratio. It had been going up nicely as the S&P had been going up. We've now seen this come down a couple of days now. With our advanced decline line studies, we're still hanging in there. We're turning down based on price and volume, but we're still well above the moving averages. And we're pretty much flat with our 5-period measure of the new highs minus the new lows. We're declining with the 10-period. We're still seeing where new highs are outnumbering new lows, but they're really dropping off. And now that volume has picked back up, you would think if we were going to be more positive that we would see this go up. But since we had a down day, this ended up declining. We're no longer extreme positive with our advanced decline ratio. Accumulation distribution actually turned up a little bit. This is a smart money gauge here, and this could end up being more positive. And the Chaikin money flow is coming down a little bit after giving us a pretty extreme reading. We want to keep an eye on this one. In our cumulative advanced decline line for the NYSE, it did decline, as probably could be expected. Our regular advanced decline line did decline slightly, but we're still positive overall. We turned down a little bit with our other NYSE advanced decline line. Common stock, we did see a decline with the NYSE, and also we saw a bit of a decline based on volume. We're turning down, but still positive with our advanced decline line studies for the NYSE common stock, the S&P, the mid caps, and the small caps. Then here's our daily chart where, yeah, this is looking a little bit scary now. If we continue to fall, we'll be wondering, is this pivot point here going to end up providing some kind of support? And then on the bottom, we did see where volume picked up. Now, the moving average is actually declining, but we're above average when measured by that moving average. Then when we look at our 20, 50, and 200-day moving average study, we're still extreme with the 20 and 50 and 200. Here's the Stochh RSI, which now has gone extreme negative. The force index has been showing some weakness here. We dropped below the midpoint. The midpoint is starting to decline. We're still positive with the force index, but we are really showing some weakness here. And our short-term stochastics is no longer extreme positive. We're turning down, but still extreme in the intermediate term. We're flat and trying to turn down just a little bit with our long-term stochastics. We're no longer extreme with the standard deviations. We saw enough of a decline to get us back into the +2 standard deviation channel. Intermediate term, we're no longer extreme with the balance of power. We're turning to a lighter shade of blue now with the go, no-go system, which is more neutral. And we're coming down with our highest high value, but we're still above the midpoint, and the midpoint continues to advance. The TTM squeeze is remaining with a darker shade of blue. That's a potential warning sign there. And we were following the 50-period double and triple exponential moving average study. As we were going up, this was providing support. Now we've dropped down below this. We haven't fallen below the double exponential moving average yet. This may end up providing some kind of support. With the ease of movement, we're turning down, but we're still above zero, so it's still positive. The Erin indicator, after being extreme for quite a while, is showing some weakness, but we're still above zero, so it's positive. We're dropping below the midpoint now with the NYSE McClellan oscillator. So that is a bit of a warning sign in the broader market. We continue to go up with the summation index based on price, and now we're going down again with the summation index based on volume. So that's a bit of a warning sign. When we look at the NYSE summation index, we're starting to roll over based on price, and we're kind of going flat, but still declining to a degree based on volume. And the Swenlin trading oscillator based on price and volume is now starting to turn down, but we're still above zero with both. We're seeing a bit of a rollover here with the PMO. This is an intermediate term oscillator. We're starting to roll over based on price, and we're actually crossing below the moving average based on volume. With our PMO studies, we have been seeing a negative divergence as the S&P has been going up with the PMOs that are rising. Also a divergence with the buy signals, and we're still extreme positive with the PMOs that are above zero. We still remain neutral for the Elder's Impulse system for the S&P. This is the big one. The dot is now on top for the parabolic SAR. And if you remember back to the early part of December when we were chopping sideways and had a down day, we spent a couple of days with the dots on top. We were able to recover from that. Is something like that going to happen this time? Now, this is a little bit more negative. We were chopping sideways when we saw this triggered before. We're actually seeing more of a decline right now. So we want to keep an eye on this one. The slope oscillator is crossing below its moving average, but it's still giving an extreme positive reading. The MACD is dropping below its moving average. So all of our oscillators, We're still extreme and starting to roll over in the short term with the slope and TSI. We're rolling over with the MACD, almost crossing with the PMO. The PPO is crossing below its moving average. So we're seeing some weakness in the intermediate term. We're rolling over with the tricks and we're crossing below the moving average with the KST. So longer term, we're also potentially seeing some weakness after giving us pretty much across the board extreme positive readings. We're still above all of the plotted moving average in our moving averages in our moving average tree. If we start to fall, the 20-period moving averages is what price will hit first, are what price will hit first. Will they end up offering some kind of support if we keep falling? The bullish percent index is starting to show a bit of a downward move, but we're still extreme positive. The NYSE bullish percent index actually turned down, but still above 50. So it's positive, but again, we want to be aware of what's happening here. We're starting to see the NASDAQ 100 bullish percent index come down, but we're still extreme positive. When we drop below 70, that will be a sell signal. The Sean trend meter is no longer extreme positive as it is showing a bit of a decline. The Chaikin oscillator, it's been declining for a few days now and it's no longer extreme positive. The money flow did decline, but is still above 50. And this is interesting. The ultimate oscillator advanced and is above 50. The vortex does show the green line coming down, but it's still on top. So it's positive, but showing weakness. The rate of change going back 50 periods is still extreme positive. The Copic curve is crossing over negative, so that buy signal is now going away. The RSI based on 14 periods is no longer extreme, nor is it extreme based on 9 periods. On balance volume is coming down, but still above an advancing moving average. We're still extreme with the stocks in the S&P 500 that are above their 200-day moving average. This is a very high reading. This means that we're quite overbought for the S&P. We're also getting a really high reading with the stocks above their 50-day moving average. So this is part of the overbought condition that we've been focusing on. The Pring bottom fisher is trying to give us some kind of a buy signal, but oh well. And then looking at the 50-day cycle, we did start a new cycle on January 2nd. Is that going to mean something this time? We had been going up. If we continue to go down, it might be that this next cycle will be more negative than positive, but we could always still recover from here. Keeping an eye on our different charts, we're looking a little bit more negative with the Heiken Ashi with the black candle. We're still positive with the Kegi, but we're pointing down. The Renko is still positive, and we're still positive with the 3-line break. And we're still looking extreme positive with our 150 and 200 period moving average studies. They really haven't rolled over yet. And we're still above this longer-term trend line with the weekly chart of the S&P going back to the 1987 crash. If we continue to fall, we'll want to see, is this area going to provide some support? We're coming back down just a little bit below the weekly chart for the NASDAQ 100. We're wondering if this area ended up providing resistance and will we start to come back down? We can always recapture this. We just want to notice what's going on right now. We are seeing where the equal weight index held up a little bit better than the S&P. And the ratio is continuing to go down. That means that the mega caps have been underperforming as the broader market has been performing better. That's what happens when we see this declining. And this is another concern where the Dow is actually up on the day, where the transports are declining. That's a negative divergence and something that is a concern to us. We are seeing utilities going up as we saw interest rates climb in Tuesday's session. The transports are still underperforming the Dow. The Dow is still hanging in there. It was barely up, but it was up in Tuesday's session. The diamonds continue to be neutral. The NASDAQ is showing a little bit more vulnerability here and coming back down to this pivot point. Will this area hold? We closed right on that pivot point. The NASDAQ 100 is also coming down to this pivot point. We were able to close above that. We've turned to negative for the Qs based on the Elders Impulse system, and we're turning negative now with the PPO. This is a momentum oscillator for the NASDAQ 100. We're crossing below the moving average. The small caps, after really going up and looking like, okay, here we go, this is starting to look a little more vulnerable here, but we did generate a recent golden cross. We still remain neutral, though, with the Elders Impulse system for the small caps. We're coming back down a little bit here with the Russell 2000 small cap index. We're no longer extreme with the RSI. If we continue to fall, will this area end up acting as support? And we also have seen a recent golden cross. The momentum in the shorter term, though, is starting to cross below its moving average. The mid caps also, after really seeing some strength here, have been showing some weakness. One thing that you can notice here is we see kind of a doji for the bar where we opened and closed right about at the same spot. Then we did generate a recent golden cross. We still remain neutral for the Elder's Impulse system when looking at the mid caps. The financial sector is still hanging in there. It was up almost 0.5%, continues to be in an uptrend. The FANG index did see a decline, but we're still above the 50-period moving average. If we keep falling here, we're going to be watching this previous red line to see if that ends up providing support. The dollar was up, and that was also a reason why stocks were under pressure. Keeping an eye on the 10-year yield where it did go back up. Keeping an eye on the 10-year price where it did come down. And then this is a chart that I showed over the weekend, and this is just a historical chart to say, okay, other times when the interest rates really started to go up and then they spiked up and started to come down, that usually meant something bad happened after that. We don't know. That's why there's a question mark right here. But last November, we got up above the 5% level, and now we've been starting to come down. Sometimes there's a lag from, oh, this is when this bad thing happened. It was back when we were hitting 5%. We don't necessarily know about that now, but we are seeing some irregularities when we study the different interest rates right now, wondering if that's going to lead to some kind of an event as we go forward in 2024. This is one of those other irregularities that we've been seeing for a while. We have the 1-month yield subtracting the 3-month yield, and this is a weekly chart, and we're still getting a positive result. This is a daily chart where we're starting to cross back above. The red line is going above the blue line. We did cross below this, but now it's starting to get a little bit more in line here. And then updating our growth to value ratios here, where we're declining with the Qs to S&P as well as discretionary to the S&P. Large cap growth is underperforming large cap value. When we look at our other growth to value ratios in the large caps, mid caps, and small caps, we are seeing weakness. We're still hanging out here for going on the third week now. When we look at the 10-day average of the S&P 500 highs minus the lows, we haven't really started to decline, at least yet. And we're still above zero with the highs minus the lows, taking a 5-period moving average and measuring the broad market. We're still going up with our new highs minus the new lows based on 50 periods for the S&P. And we're still looking extreme with our 50-period moving average study for the stocks in the S&P. After getting extreme, we're starting to come down with the mid caps and also starting to come down with the small caps. The S&P to utilities ratio is chopping around right now. As it was going up, that was giving support to the S&P. It's kind of in limbo currently. We are seeing the 2-year yield declining, which has been giving support to the S&P. If interest rates start falling, especially the 2-year, that could give more support. And with the Staples to S&P 500 ratio, it really spiked up, which also was putting some pressure under the S&P. But longer term, it continues to decline. So what's our outlook for Wednesday? We have 1 day left of the Santa Claus rally to see what's going to happen. We're still in that period of time figuring out, is the January effect, which is typically positive, is that going to continue? Our technicals, we're still positive. We still have a lot of overbought conditions. Is there weakness starting to develop, or are we just working off some of these overbought conditions? We will get the MBA Mortgage Applications Index. This is the big one. The ISM Manufacturing Index, the JOLTS job openings, and then the FOMC meeting minutes will be coming out as well. So we've got some pretty hefty news being released in Wednesday's session. Keeping an eye on the different geopolitical events, specifically any kind of escalation in the Middle East. When we look at Israel and what's going on in the Red Sea and different things that are happening there. On Thursday, we will get the ADP employment change. We'll get the final reading for the services PMI, not really influential. The other big part of this week is going to be on Friday. We're going to get the employment situation report as well as the ISM non-manufacturing PMI. Seasonally, and this is new, and I finally changed this over to January. Whatever happens in January, the market tends to follow that 72.6% of the time when we have an election year. The January effect can continue. There's really no end date for that. Like the Santa Claus rally has a definite period of time. And this is when small caps often outperform. Over the last 74 years, in January, we're up 59.5% of the time. We're down 40.5% of the time. I'll go over these other statistics as we get closer to options expiration. We're positive with the Dow looking seasonally, but we're neutral to negative with the S&P and NASDAQ. We will be on the second trading day of the month. We're following the green dashed line, which tends to be positive during an election year. Here is the potential January effect. This is what's happened historically. And so far it appears to be happening, but doesn't mean we go straight up. Are we going to see a little bit more strength coming back into the small caps? And we're wondering, is 1982 and then what we were seeing in 2023, we were seeing some similarities here, where after that, going in forward from 1982, we saw strength. Is that going to be what happens in 2024? But then when we look at the presidential election year since 1950, we do start off pretty choppy here. That's the dark blue area. And we had a down day. And so we don't really start to see some strength until later on as we get into the first quarter. And then here's another updated version of the Stock Traders Almanac chart. We're looking at the green dashed line. It is pretty much flat when we start into the new part of an election year. But then when we take all of the year together, it does look more positive. When we look at the green line, then we see some negativity going into March and then seasonality as it plays out for the rest of the year. This is updated from Carson, where Wednesday tends to be the most negative day of the week. So our scenarios, we're not going with the down one yet. We are seeing some weakness, and you can't really deny that, but still, our charts are positive. Now, we're extreme positive, and we're watching to see if weakness is developing, but for right now, we still maintain more of a positive stance. We're still concerned about the condition of our trend because both our short and intermediate term ADX charts are really extreme, even though they're dropping below their moving averages. The warning signs, growth. This has been a concern now for quite some time. It's actually showing weakness now. The 5-period equity put call ratio is going up. That's short to intermediate term negative. The transports are negatively diverging from the Dow. That's also quite negative. The 1 to 3 month short-term bond spread continues to be positive when it should be negative. The parabolic SAR chart has turned negative. The Copic curve has also turned negative. We're looking more negative with the NASDAQ 100 with the PPO momentum oscillator turning negative. Positive, we still have kind of a long list here. The daily special K chart is positive. Our longer term equity put call ratio is going down. That's positive. The risk on posture is still going up overall, but we've seen a couple of down days now. Our oscillators are positive. They are extreme positive, and they're starting to roll over. The vortex is positive. The bullish percent index is coming down just a little bit, but it's still extreme positive. The Zohorchak method continues to be neutral. And we did see recent golden crosses with the Russell, the small caps, and the mid caps. And small and mid cap growth continues to be positive, but more or less chopping sideways. And financial sector, it's been one of the stronger areas going back over the last couple of months. And at the very bottom, you probably can't see that. Our 50-period longer-term new high, new low study continues to be positive. So our conclusion, we're positive. We continue to have a number of overbought indications. Is weakness starting to develop? We're mainly watching that in the short term for right now. If it starts to pick up some strength to the downside, that may go over into the intermediate term, but we still continue to be overbought. The long term, we're also overbought with our longer term moving averages. And as long as we stay above the 200-day simple moving average, we continue to be positive. Thank you. I hope you found this helpful. I hope you have a great day, and I will talk to you in the next video.